Hi, everybody. I'm Brittany Lewis, a breaking news reporter here at Forbes. Joining me now is Steven Ehrlich, Director of Research for Digital Assets. Steven, thanks for coming on again.
Great. Thanks, Brittany.
Of course, you offered this really stark warning for Forbes. Beware of Flatcoins, crypto's inflation busting fad. But I think to really heed this message, we need to first take a step back and talk about stablecoins. So let's start from the beginning. What do we need to know about stablecoins?
Right, and I think that's a good place to start. Stablecoins have been around longer than most people realize. In fact, stablecoins actually started around 2014, so almost 10 years ago, and these were created, I guess, as a solution to an early problem that Bitcoin advocates found, which is that as much as Bitcoin achieved its purpose of being decentralized and sort of immune from government interference, it did not really meet the standard of what we consider to be for modern money, in the sense that although maybe it could serve as a unit of account, as a means of exchange, it did not have very high throughput, and its excessive volatility made it difficult to really be a store of value, even though its hard cap of 21 million units might help it appreciate over time. If you're going to be using it to buy goods and services, or if you're a company and you're looking to use Bitcoin as a way to sort of manage your treasury, you would not be able to withstand 10% swings, either up or down, when it comes to paying expenses. So for all those reasons, stablecoins were created, which essentially are blockchain-based tokens. They run on top of Ethereum and most of the other major competitive blockchains out there. So they move faster, and in many cases, they're pegged to the price of an underlying asset, typically the dollar. Now, stablecoins come in many shapes and sizes. They're not all the same. The most common ones today, such as Tether, and which is sometimes known by its acronym USDT, and USD Coin, which is frequently referred to as USDC, they are backed ostensibly one-to-one by either cash in deposit at a bank, or other what's known as cash equivalents, like U.S. Treasuries, short-term dated U.S. Treasuries. There are, especially in the case of Tether, some more esoteric assets, digital assets, and longer-term loans. But that's really what the backing is supposed to be. There are controversies, especially surrounding Tether, because it's yet to disclose the full extent of its banking relationships, and the fact that it is an international company has led to many questions, some of which we've investigated at Forbes to try to figure out exactly what is behind Tether, because Tether in particular has grown to be an $80 billion asset and the key liquidity provider to the $1.2 trillion crypto market. So if there were ever rumors that, or if there was ever evidence that Tether was not sufficiently backed, it could be calamitous for the crypto industry. But aside from those stable coins, there is also something known as an algorithmically backed stablecoin, which typically utilizes some sort of endogenous token to sort of help maintain that price balance. The most famous, or I guess infamous, example of that is Terra USD, or which was backed by its sister token Luna, which famously collapsed about a year ago, evaporating about $45 billion worth of value. And then there's also some more over collateralized crypto stablecoins, the most famous of which for that is DAI, which has a market cap of around $5 billion and has been around for about 8 or 9 years or so. So those are the different types of stable coins. But they did have one key problem that's very central to crypto users, which is why this new crop of entrepreneurs created something called a flat coin, which is supposed to be an inflation protected stablecoin.
So when you think of the name of this token, you think it's stable, obviously, you think it's safe, but based on what you're saying, that's not really the case, correct?
Right, Brittany. So these stable coins, by the very name, are supposed to be ultra low risk, and are in a sense supposed to be boring. But that has not always been the case. I mentioned in my previous answer the circumstances that surrounded the collapse of Terra USD. Tether, again, has been sort of shrouded in controversy basically since its inception. And then even USDC, USD coin, which is issued here in the United States by Circle Internet Financial, based in Boston, and is also co-managed by Coinbase, the largest U.S. crypto exchange. That was seen as, in many cases, or by many people, as the safest stablecoin out there. But that actually took a bit of a reputational hit back in March because it was revealed that amidst the banking crises that we've spoken about before, in particular the collapse of Silicon Valley Bank, Circle actually had $3.3 billion in collateral in that bank. And it turns out that they were made whole, but in the couple of days it took for the FDIC, the Fed, and the OCC to determine or come to the agreement that they were going to guarantee all deposits, no matter how far in excess they were of the $250,000 limit that everyone kind of has seen at bank signs when they've gone into their bank. There was a problem there, and the price of USDC collapsed below 90 cents. I think it got down to as low as 88 cents to the dollar when investors of this token realized that there may be, I guess, a $3.2 billion shortfall in collateral underpinning what at that time was about a $40 billion token. So there were fears there, and for all of those reasons, even USDC had some issues.
So now let's talk about the past year and a half. Obviously, we've seen inflation, and at one point in the summer of last year, we saw inflation hit a 40-year high. So then Flatcoins were introduced to keep up with this inflation, but that sounds almost too good to be true. Sorry, I sound like a skeptic, but is it too good to be true?
Right, and that kind of Flatcoins in many ways go back to sort of the initial promise of crypto. I mean, Bitcoin was created 15 years ago as sort of a protest to, I guess, the largesse, or I guess some people will call it fraud, or just the poor risk management that precipitated the 2008 great financial crisis. And then in addition, the vast monetary stimulus that sort of led us out of it to what was a decade plus of prosperity until the coronavirus crisis hit again. Stablecoins sort of helped limit price volatility, but they were not immune to inflation, which, as you just mentioned, Brittany, is still at the highest that it has been in decades. And sort of Flatcoins were meant as a way to sort of harken back to, I guess, in some ways, that early crypto ethos, which was to sort of be immune to inflation. Inflation can sometimes be a political boogeyman. It can be sort of a trigger word for some people, especially in crypto, because they see inflation as sort of the Fed and its counterparts around the world arbitrarily printing billions and trillions of dollars in an effort to prop up governments and do all types of things that the most Puritan crypto believers believe to be immoral or illegal, depending on how they see it. Inflation is not necessarily a bad thing, but inflation needs to be held into account and or held in check. And in circumstances like this, where inflation has gone up in some cases earlier this year or late last year, 10% year on year, everybody who takes a salary, everybody that holds dollars in a bank account, was basically seeing the value of those holdings evaporate into the ether, no pun intended. So Flatcoins were really seen as a way to try to help create a stable coin that's not necessarily stable to the price of the US dollar, the world's global reserve currency, but stable to a particular standard of living, which in this case, or in the case of the projects that I detailed in my report, really focus on the CPI, which is released by the Bureau of Labor and Statistics, or in one particular case, sort of a bespoke Moneyball-esque approach to creating what one firm sees as a more accurate indicator of inflation.
When you wrote about this for Forbes, you described the basic mechanics of Flatcoins as complicated and risky. Why? What's the risk here? Because when you say something like immune to inflation, that sounds great, especially in this economic climate. But what's the risk?
Right. So there is always risk when you are trying to generate additional yield for tokens, and despite all the marketing terminology and jargon that is being promoted by what I believe to be well-meaning, well-intentioned entrepreneurs that are trying to solve a problem that is worth addressing, something has to happen in the back end to generate those additional returns. If inflation is up 6% or 7% or 9% or 10%, something has to happen behind the curtain to create those additional returns that then can be passed on to the user. So what typically ends up happening is that the collateral that is given to these platforms is then essentially invested in or deposited at decentralized finance, what's known as DeFi lending protocols and decentralized exchanges, where those assets are essentially used to help provide liquidity to that multi-billion-dollar industry. And then the returns accrued from essentially the returns accrued from lending out those assets go back to the initial minters of those flat coins. So each different project has some unique permutations. Some are more complex than others, but at a very basic level, that's how those work. And I think it's important, and that's what we tried to illuminate in the report. It's important for purchasers of these tokens to understand that while these programs may try to invest assets or place assets in more mature DeFi protocols and try to help ensure or minimize the risk associated with participating in DeFi, there are real risks, and DeFi protocols have been hacked. They have been manipulated, that have led to hundreds of millions of dollars in losses for investors. And in some ways, to me, it seems a little curious to do this, especially if the return in some cases is just designed to mimic inflation, which, despite still being at record high levels, is going down. I actually spoke to an economist at the American Institute for Economic Research who had studied some of these flat coins a few months ago. And I mean, one of the things that he mentioned to me is that this may have been even more compelling when inflation was 9 or 10% year on year, but now that it's I think under 5%, we're going to get a new inflation print tomorrow. We're hoping that it's going to go down even further. What is the real yield? What is the real return here? So there is a considerable amount of risk associated with these tokens for returns that hopefully are going to be going down as inflation recedes.
That brings up a really interesting point, because as it has always happened, inflation will eventually cool down. So when that happens, will flat coins become obsolete?
That is a good question. I don't think that they will become obsolete because inflation, I mean, the Fed has a targeted inflation of I guess like plus or minus 2% and a few percentage points. And I mean, that's something that hopefully will continue in perpetuity because it does help the economy grow. And then again, if we're looking beyond the United States, especially to more emerging markets where inflation is commonly at double-digit levels, sometimes 30, 40, 50%. Failing economies, it can be even higher if they're undergoing hyperinflation. These are real problems. And stablecoins, in the US, we think of stablecoins as a necessary source of liquidity for trading. But in emerging markets, stablecoins can be a really great hedge against fiat currencies that are just evaporating in value. And these are circumstances that citizens around the world have dealt with for years and decades. So if there is a way to have a stable coin that is secure and protected against inflation, I get the sense that may have some more staying around power. But again, you have to kind of weigh the risks and returns, because there are stable coins that exist right now, and the US dollar, despite the fact that it's still at high inflation, despite the fact that it's still being devalued because of high inflation, is much more stable than other currencies around the world. And actually, I reached out to many. I reached out to Circle. I reached out to Tether. I reached out to MakerDAO, which is the decentralized autonomous organization that operates the DAI stablecoin, to try to get their thoughts on flat coins. None of them really responded to me, and I get the sense that none are interested in pursuing flat coins strictly because of what is the risk return there. And then the other question associated with flat coins that I think will need to be addressed at some point in the future is whether or not they are securities. Stable coins themselves are in a bit of a regulatory gray zone. There is a bipartisan bill in Congress designed to provide some rules of the road in stable coins. It was drafted last year, and there were high hopes for it. but right now its future is a little bit uncertain. In fact, the Republicans recently introduced their own version of the bill that has led to, I guess, some squabbles among the two different sides of the aisle. But regardless, there's a question as to whether or not stablecoins are securities, even if they're not designed to increase in value, which typically is one of the real conditions for something being deemed a security or an investment contract. Now, if you incorporate flat coins, which are designed to appreciate in value, even if it's just to maintain a common standard of living, that creates more questions. I actually spoke to Stefan Rust, the CEO behind Nuon, which is the first flat coin, and I asked him that question, and he kind of acknowledged that flat coins are in a bit of a regulatory gray area. So for all of those reasons, I think it's unlikely that any of the big players are going to get involved in flat coins. And then one other small point there too is that there are some natural ceilings to how big these flat coins can grow. Unlike Tether or unlike USDC, where they can take in as many dollars as somebody wants to give them and just mint out a corresponding amount of tokens. With flat coins, there needs to be a way to generate the returns with the collateral at scale without changing risk parameters. And the founder of the other project that I detailed in the report, Sam Kazemian, who was behind the Frax protocol, or FPI, which is their flat coin, told me that right now there's a soft cap limit on the amount of FPI which can be created at $100 million, because he's worried about finding enough responsible places to invest the collateral to generate the necessary returns. So for all those different reasons, I know this was a bit of a long-winded answer. Flat coins may have a future, but there are still a lot of things that need to be worked out.
You brought up an interesting point from our last conversation about crypto regulations, and you said last week there needs to be some, lawmakers are trying, it seemed bipartisan, and then maybe not so much. But when you add flat coins into the mix here, you said they're not regulated at all. Is it almost like the Wild West?
It is a bit of a gray area, and I actually did speak with a number of lawmakers and regulators for the story, none of whom wanted to be quoted by name except for one, Brad Sherman, who is a noted crypto critic. He's a Democratic lawmaker from California in the House of Representatives, and he basically said we already have a good way to protect against inflation. They're called TIPS, or Treasury inflation protected securities, and so he kind of dismissed it. But at the same point, I think this does underscore how, while lawmakers in Congress in Washington, D.C., and even around the rest of the world are still trying to figure out what to do with crypto, who are the appropriate regulators, what are the guardrails to put in place, how much leash or how much leeway should these platforms be allowed to have, the entrepreneurs, the builders, keep their heads down and they keep trying to come up with innovative solutions and innovative approaches to challenging problems. And flat coins is just another example of this. And again, like the stablecoin drafts that have been going around, they typically focus either on the more traditional type of stablecoin, where again, I give you $1, you put it in bank, you give me a token, or the endogenously collateralized stablecoins such as the Terra USD. And now here's this third kind that is not mentioned anywhere in either of the drafts, and we'll need, especially if it keeps growing, to find a way in, so that there is no regulatory uncertainty associated with flat coins. So it just underscores the urgency of the moment, I think.
Obviously, alarm bells went off for you. I mean, you wrote a piece warning our readers to beware of flat coins. You didn't get a response from Circle and other big names in the industry, but from those who are responding, or in the industry in general, give us a pulse check here. What is the response in the crypto space to flat coins?
The response in the crypto space is not uniform. There are some very big advocates for flat coins in crypto, in particular Coinbase, which interestingly is a key partner of Circle and issues USDC. In fact, Coinbase went in and announced its own layer 2 blockchain, essentially a scaling network built on top of Ethereum, designed to be interoperable with that network. It put out a call to developers looking to seed projects to sort of bring people to its network, kind of a field of dreams. If you build it, we will come. And one of the types of projects that it tried to encourage developers to work on is Flatcoins. So Coinbase is obviously Coinbase, the US's largest exchange and really a bellwether for especially mainstream crypto sentiment, is bullish on Flatcoins, despite the fact that it continues to support USDC. And at the same time, like once you start talking to traders and other folks with real fiduciary responsibilities to investors and so on and so forth, it really then becomes a risk reward calculus. Sure, it would be great to not see yourself lose 5% or 10% of your holdings just by keeping them in a bank. But at the same time, there's other options. I mean, most traders don't like to keep more assets in stable coins than necessary because it's hard to earn returns on that. And there's other ways, even taking money outside of crypto to generate 4 or 5% returns, such as using money market funds and so on and so forth. So for the investment community, I think it's still kind of a prove it situation. But if there's any ecosystem or community that's going to be accepting of flat coins, it will be crypto.
Steven, I appreciate your report. Thank you so much for joining me.
All right. Thanks, Brittany.